And with that, off to Mike McKee. He's at the Fed in D.C. Mike.
Well, no surprise, the Iran war and tariffs were central to the discussion among Fed officials at their March meeting. The full effect of tariffs had not yet moved through the economy, officials said. A resilient economy, they called it. And the war, then only a few weeks old, raised the threat of inflation increasing and hiring slowing. Some participants judged there was a strong case for a two-sided description of the committee's future interest rate decisions in their post-meeting statement, reflecting the possibility that higher inflation might call for rates to be increased, although no member called for a rate move at that meeting. Most participants raised the concern that a protracted war could lead to further softening of labor markets, which would warrant additional rate cuts. But many participants pointed to the risk of inflation remaining elevated for longer than expected, which, quote, could call for rate increases. The vast majority of participants noted that progress toward the committee's 2% objective could be slower than previously expected, the minutes say. Labor market conditions appeared vulnerable to adverse shock, they say, most participants highlighting the risk that a protracted conflict in the Middle East could weigh on business sentiment and further reduce hiring. As for policy, most participants felt it was too early to judge how the war would affect the economy. Many participants judging that in time it would be likely become appropriate to lower the target range for the federal funds rate if inflation were to decline in line with their expectations. A couple highlighted, though, that they had pushed their assessment of the most likely timing of rate cuts further into the future. Stephen Myron, though not named, was the only dissenter. The minutes do note that one participant argued rates were still restrictive, and that was increasing risks to the labor market.